All right, everybody. Now we have company presentation from Firstsource Solutions Limited, a specialized global business process management services provider, partnering over 200 plus global companies, including 19 Fortune 500 and 3 FTSE 100 companies. Now for the presentation, we have all the way from US, Mr. Ritesh Idnani, the Managing Director and CEO for Firstsource Solutions Limited. And on stage, we have with us Mr. Dinesh Jain, CFO for Firstsource Solutions Limited. We also have with us Mr. Pankaj Kapoor from the company. And now I'll give it over to them. Let's start.
So firstly, apologies for the snafu in the first session as well. And sorry I'm not there with all of you in person. I'm actually on holiday sitting in Maui in Hawaii right now. Thankfully, the time zone actually works, so it's only 8:30 in the evening right now for me. But I'm very excited to be with all of you, and I was looking at the list of all the folks in the room, so sorry I can't see each one of you in the room, but I've not had the chance to meet with several of you in person, so I thought we could break this in three parts if that works. And rather than walking through a formal slide pack itself and walking you through a set of slides, which I'm sure y'all can all go through in short order, what I thought might be useful is to tell you a little bit about my background, why I chose to come here and join Firstsource almost a year back. I joined in the last week of August last year. We're getting to that point where it's a year since I joined. To tell you a little bit about what caused my interest and prompted me to come on board, and then tell you a little bit about what we're doing or what we have done in the last 1 year, and then what's in store for us. Try and keep this as a free format conversation for the first 15 to 20 minutes. And then between Pankaj, Dinesh, and I, we're open to any questions that you all might have. I hope that works as a format. So a little bit about my background. I've spent about close to about 30 years in the industry. I'm not a technologist by background. I'm a banker by profession, actually from your side of the house. I used to work with Citi in the corporate investment bank out of business school. And I'm an accidental interloper into the field of tech, although now I've been there long enough to be considered dangerous. I joined Infosys way back in 1999 when it was a $100 million business and saw the growth to an $8 billion revenue company when I left. During the 12 years that I was there, I spent time building out first their financial services industry vertical, which is their largest business to date, and then their BPO business, which today is about a $1.6 billion business. I then went on to do a turnaround situation for a mortgage-backed SaaS business, and then a startup in the healthcare space, which was way ahead of its time for a problem that's still not been solved. I then went to join Tech Mahindra and successfully led their BPO business, which was a flat, stagnant, underperforming business, grew it 3 times during the time that I was there. It was growing at a 20% CAGR, while we also expanded EBITDA by about 2.5 percentage points during the time that I was there. And during that time, the BPO and the platforms business that I had the honor of leading contributed about 80% of the incremental growth of the company. I went from Tech Mahindra to the SaaS AI side of the house to a company in Silicon Valley called Unifor, which was backed by John Chambers, former CEO of Cisco, who was the chair of the board. And my role there was to partner with the founders to help scale the business to the next level. During the time that I was there, we grew the ARR, the annual recurring revenue of the business, more than 3x. Also successfully raised a Series E round, valuing the company at $2.5 billion, increasing the valuation by almost 6 times during the time that I was there. And then Firstsource came knocking along last February. Actually, there were 3 opportunities that came on my table within a span of about 10 days, 3 CEO jobs. And when I evaluated Firstsource, there were a few things about the Firstsource opportunity that caught my attention. First and foremost was what was prevailing in the market environment itself. The macro had shifted. In fact, all of you are in the financial services field. But since 2008 till going back till 2022, we pretty much had been in a zero interest rate environment itself, from the 2008 financial crisis. And therefore, money was easy to come by. It was a growth at all costs playbook. And that was shifting to a growth and efficiency playbook as evidenced by a lot of our enterprise clients. The second thing that I also was looking at was another important, equally important shift, which happened on November 30th, 2022, when Chat GPT was launched by OpenAI. And I felt that that was another thing that was going to change the way the world operated. It's not often that you have one shift. It's even rarer when you have two shifts playing out concurrently. And I felt that these two shifts created significant discontinuities in the market environment. Discontinuities in turn create opportunity, and opportunity creates two kinds of reactions. Either companies play on offense or they play on defense. I saw an opportunity in Firstsource to play on offense and capitalize on the emerging market opportunity, and that was the first driver that prompted me to consider coming on board. The second thing that caught my attention was, whether by accident or by design, Firstsource ended up being largely in three industry verticals: financial services, healthcare, telecom, media, and technology. And these three industry verticals give us, even today, almost 95% of our revenues. And personally, for me, that aligned with my own value system, which is less is more. It's better to operate in a limited number of swim lanes rather than trying to be everything to everybody. The third thing that caught my attention was the client base. When I was doing my due diligence on Firstsource, coming on board, uh, I was actually quite amazed with the roster of customers that Firstsource was working with. These were some of the best brands in the business across the industry verticals that we operate. All household names, names that each one of you would recognize in the US and UK markets. And personally, from my vantage point, when I looked at those relationships and I looked at the people that Firstsource worked with in those accounts, the access they had to the C suite, the duration of those relationships, given the fact that several of these were more than 10 to 15 years old, that was something that was very appealing to me, because more often than not, you don't run into this in any other competitor environment. And I've seen several of our competitors, and I could draw the distinction almost instantly. In fact, I would have given my left arm and right leg to work with any of those logos itself. That being said, what I also noticed is that our footprint in those accounts was not representative of the duration and the depth that we had in those accounts itself. I'm a glass half full guy. So I saw that as an opportunity to actually uh, have headroom for growth, and saw that as potentially a market opportunity that one could take advantage of again. Last but not the least, I also felt that my own background was going to be very relevant in the current context to what Firstsource needed. Most of my peer group CEOs in the IT services and the BPO space are career services folks. They have worked in the services industry all through their lives, good or bad. That's the nature of the experience that they've had. I felt that the current environment was going to be critical, where folks who've seen the SaaS AI ecosystem, as well as seen the services world, were going to be relevant for what was emerging in the current ecosystem itself. A combination of all of these factors led me to come on board August 31st of last year. Cut to where we are today, right? And I'll talk a little bit about the last 1 year journey itself. Within the first 30 days of coming on board itself, one of the first things that I ended up noticing is that almost 90 to 95% of the observations that I had, or the hypothesis that I had coming on board, were playing out to plan. There was, in fact, I was actually quite surprised at how accurate those hypotheses were. What I also noticed when I spent time in the first 30 days, I ended up meeting almost about 80% of our customers from a revenue standpoint, and covering, crisscrossing the world, meeting about 90% of our employee base. And if nothing else, what came out very strongly for me during that time was also the fact that our customer base was very strong, but also the headroom for growth was huge. And at the same time, the way Firstsource had grown as a business was as a set of monolithic entities where the left hand didn't always talk to the right hand. It was a set of fiercely independent units, for good or bad, but that was the way the company had operated. And that really led to the creation of the One First Source framework, which I felt would be the North Star and would be our guiding principle governing how we would operate, what our common ways of working would be, how we would actually go after the marketplace itself, how we would treat customers and employees, and how we would evolve the rules of engagement to actually grow the business itself. And my view was that if we executed on One First Source really well, that would be our North Star for delivering top quartile industry growth as well as improving the profitability of the business structurally over the medium term. And that really became the war cry or the mantra which governed the business and has governed the business and will govern the business over the next few years. So let's talk a little bit about what the One First Source framework was. There were seven broad themes that lay at the foundation of One First Source. The first one was simplifying the organization itself. And why was that important? Historically, the way Firstsource had been organized, there was no distinction between market units and capability units. Anybody could go out there and own a customer relationship. And therefore, the net outcome of that is several of our customer relationships, we were one trick ponies. We had one capability or one service line represented, but not the full range of our services. And one of the first things that I ended up doing, effective Jan 1st of this year, is creating three broad vectors or three broad legs of a stool itself, if you will: market units, capability units, and enabling functions. We said there are four market units: financial services, healthcare, telecom, media, and technology for the North American markets, and Europe would be a separate geo. And then we said there would be five capability units, and every market unit would take the full five capability units to their customers. So the account would effectively become the unit of currency. Sanjeev talked about this in the morning session where he said there were some very simple value unlocks. This was one of those very simple value unlocks which everybody else in the industry had done, but we had not, and we went ahead and executed on that. The second part of it, of the org design, was also being able to get some very seasoned leaders were relevant in the industry. And we've been fortunate to attract some top notch talent. If you look at the leadership cadre that is now there, several of my direct reports in the exec team, as well as one, two levels below. We've been able to get people from several of our competitors, several of whom who are playing larger roles than what they're doing for us here. And they've all signed up for that one common purpose and vision of what we're trying to do to disrupt the way this industry operates. The second part of the One First Source framework was going out there and cross-selling and upselling into our customer base. If you recall, a few minutes back, I talked about the fact that we had this fantastic roster of customers, but we were not fully penetrated in the same as well. And one of the things that we've done since then is identify about 50 plus accounts in our portfolio and said these accounts represent significant headroom for growth. And within these accounts itself, we have put account plans in place. We've got dedicated client partners, which we have invested in the last 3 quarters, expanded our go-to-market team by almost a third, and hired several people to go out there and focus on these accounts to improve our share of wallet in those accounts itself. Mind you, growing revenues in an account is more science than art. And that's one of the principles, again, as a simple value unlock that we have tried to do. I spend almost an hour every quarter per account on these 50 plus accounts to ensure that we are continuing to monitor the progress and meeting key stakeholders in those relationships itself. The third thing that was part and parcel of One First Source was amplifying the brand. I'll go back to a story. When I joined Firstsource about a year back, and because I've been in the industry, you get to know a lot of the analysts and advisors and so on and so forth. And several of these are people that you've known for 10, 15 plus years. When I told them I was coming on board here, they were like, Firstsource who? And what do they do? And when I told them about some of the cutting edge capabilities that we had and, the fact that we were deep domain, I think they were surprised. This was a story that had not been told. I don't think we've done a very good job of amplifying the brand and bringing the story to the forefront itself. And that's one of the things that we try to do. We hired a new chief marketing officer. If you now go to our social media handles on LinkedIn or Facebook or any other platform, Instagram, wherever else, I think you'll see a lot more visibility that we end up having because of what we've been able to do. We're also the recipient of several more awards, and a lot of the good work that we're doing is actually coming to the forefront. So we were historically, maybe we were shy of not getting the message across, but we're a lot more aggressive. We're in your face, and in a very counterintuitive way, one of the things that actually defined First Source was the fact that we were very scrappy. We're very entrepreneurial, right? We get shit done, for lack of a better way to put it, right? And that became the face of our new brand identity where we said, we make things happen. If you look at all the paraphernalia that's coming out right now around First Source, it will all be centered around this broad theme around we make things happen, which represents the new amplification of the brand itself. The fourth theme that we talked about is tech in everything we do. And this was critical because we had to lead from being tech first. This was the way to disrupt the market. This was the way to expand the market. This was the way to take share from our larger competitors as well. And tech first meant that we had to have a very strong, vibrant startup ecosystem that we partnered with. And in fact, one of my first external hires was actually getting in a head of partnerships from the outside who helped launch the partnerships itself. I spent about 2 to 3 hours a week meeting new innovative partners just to know what they have. And there's a symbiotic marriage to be had out here. The partners have interesting IP. We don't have all the solutions, but we can embed what they can bring to bear in our solutions and take it to customers. And we have the customers, they don't. Right? So there is a marriage to be made if done right. And this is one of the things that we are doing as well. And that's now starting to yield some fairly interesting results in terms of just going with a tech first proposition in everything we do. The fifth thing that we said is let's expand our capabilities, right? So we are refreshing or modernizing our existing capabilities. I talked about our collections capability being cutting edge, world class. In the last 1 year, we have infused AI and ML into our collections capabilities, into our platform to improve the propensity to pay. If you got credit card debt, and let's say I've got credit card debt, right? And let's American Express trying to reach me. They should know that the best time to reach Ritesh is 5 o'clock in the morning because that's the time he's likely to open his emails and respond right away, right? The ability to use AI ML to have a very personalized interaction improves your propensity to pay. And we have infused some of these things into our platform. So modernizing our offerings, launching new offerings. Okay, perfect. So I was talking a little bit about our capability refresh and the fact that we are spending a lot of time modernizing our offerings and at the same time as well as launching new offerings in the marketplace as well. The sixth theme that we've been spending a lot of time is around elevating our employee engagement. Again, a very simple value unlock, right? We had a high attrition rate. We've been increasing the number of interactions we have with employees. Attrition has come down by almost 10 percentage points in the last 1 year. And last but not the least is improving profitability. We've identified a set of about 24 initiatives which will allow us to improve our profitability by almost 300 basis points over the medium term itself. The net effect of all of this, right, if you look at the last 3 quarters, and it's now getting to almost a year since I joined, right? This is week 52. But if I look at the last 3 quarters, in Q3 of last financial year, we had a 3.2% growth quarter on quarter from a revenue standpoint while holding our margin line. In Q4, our growth was 4.2% quarter on quarter sequentially while we continued to hold the margin line. And in Q1 of this year, our growth was 6.6% quarter on quarter while we continued to hold the margin line. In fact, At the end of Q4, when we came out and talked to the market, our guidance to the street was 10 to 13% from a revenue standpoint, while holding the margin lines at 11 to 12%. And we also said we were comfortable to provide guidance for $1 billion run rate business by FY26 Q4. And we also said on the margin front, after this year, since there would continue to be investments, after FY25, we would improve margins by 50 to 75 basis points each year over the next 3 years. Our view is that that opportunity exists in a meaningful way. If anything else, our Q1 performance is only reflective of of the potential that is there. And if you look at our Q1 performance, after the results, we went ahead and upped our revenue guidance from 10 to 13% to 11.5% to 13.5%, which is the highest in the industry across small cap, mid cap, large cap, whether it's IT or PPO companies itself. We feel good about what we've achieved so far. We feel comfortable with the value unlocks that we have identified. We feel comfortable and confident with what we are executing under the One Firstsource theme. And I talked a little bit about the 7 themes that underlie One Firstsource. That is our North Star, and as long as we keep executing to that over the next 3 years, achieving the 15% growth that Sanjeev talked about and getting to a 14% operating margin is well within our grasp itself. And that's what gives us the degree of comfort from an execution standpoint in terms of how we are approaching the market and what we are seeing as acceptance from our customer base in terms of the financial and operating performance itself. Let me pause there for a moment, but hopefully that gives you a little bit of the story, starting with why I chose to come here, what are we executing on under the One Firstsource theme, and what are the financial outcomes that we've seen over the last 3 to 4 quarters, and therefore what does it look like going forward?
This is Debashish from Swan Investments. Sir, one question that I have, maybe we had this discussion in the past also. Before you joining in, FSL was a company which is largely focused on a few of the cyclical parts of the business, especially in BFS. And post you joining in, we are seeing that you are moving out of that trajectory and started creating more of consistency, annuity-driven business. So if you can give some idea that what part of our business is now dependent on those mortgages and collection businesses of BFS, and how much you have moved out from that. So that is first question. I can continue with the second question, or we would like to answer the first question first? The second question is, if I see our telecom media business, the dependence on one single customer was very high. And that has, and their shift in strategy also impacted our revenue performance last year. So what is your strategy on that side in terms of reducing the dependence on few single customer and moving towards more of larger base of customers there? Or is that a strategy, or that is not a strategy at all?
No, thank you for that question. Let me address the second question first, and then I'll come to the first one. On the second question, firstly, we see significant scope for expansion in the client that you talked about still, even though we have a large share of wallet out there, but we still see headroom for growth. That being said, what we've also done both in the US, UK, as well as now in the Australia, New Zealand markets, is we have stepped up our footprint in the telco vertical itself in terms of the client base that we are going after. Mind you, telecom is one vertical, which is a very mature market from an outsourcing standpoint. Everybody is, every telco is outsourced for the longest time, but that doesn't mean that there isn't an opportunity to get into any of those accounts itself. If anything else, it plays well to our positioning in the market as a disruptor. And we are using that to actually expand our footprint in the telecom space itself. So we've had success, for instance, in the last 2 quarters where we've added a couple of logos both in the US and the UK market on the telecom side. But in addition to that, in the media, ed tech, as well as in the consumer tech side, we've seen significant traction there. In fact, on the consumer tech side, some of the work that we're doing on the AI ML side uh, is something that is seeing a significant amount of traction, and we continue to expand our footprint there as well. I'll bet all of these are on a smaller base, but you'll start seeing a lot of these accounts continue to gain foothold as they scale up as well. So we feel very encouraged with what we're doing in the market as well. In the edtech space, for instance, we don't run into any of our traditional outsourced and offshore players at all. So it's a market that's available both with the edtech players as well as with the universities. So again, there's a huge market opportunity that we find ourselves in a very enviable spot in terms of what we are seeing in the marketplace as well. Now, coming to your first question related to the mortgage and the collection side, if you look at the commentary that I've been providing now for the last 4 quarters, our objective of the first source of the future is to build a business that is secular, durable, independent of the macro. It's not to say that we don't see the same macro commentary and we are not immune to the macro like our competitors, etc. But one of the things that you will hear from us is the fact that is the steps that we have taken to ensure that we are building a business that is as independent as possible on the macro. Let me give you an example on that. On the mortgages side, we have increased our footprint and our contribution coming from the servicing and the home equity line of credit, which tends to be interest rate agnostic. We've tried to go after the regional banks, the larger banks who historically used to do a lot of work with us on the collection side, but now they see an opportunity to work with us on the transaction processing side as well as on the mortgage side of the house. So a lot of these... Sorry?
Continue, Ritesh.
Yeah, a lot of these are also creating opportunities for us to grow our footprint and our contribution in the mortgage business itself, independent of the origination side, which tends to be interest rate sensitive itself, if you will. Similarly, on the collection side, I mean, our footprint today is across first party, third party, and legal collections, but we also have an underlying digital collections platform, which tends to be a high margin business, which is AI ML infused. And we're using that as a self-service, low-touch, easily configurable environment, which allows our clients to onboard and start collecting debt quicker as an opportunity set to actually expand our footprint itself. So both of these, if you look at the way we are approaching the market from a go-to-market standpoint, I think it gives us a lot of comfort. And therefore, you see actually our share and contribution from the financial services side has held steady over the last few quarters.
Thank you for answering those questions. Just one continuation. Do you want to or like to quantify that what is the percentage of our BFS business is currently coming from that interest rate sensitive or collection areas, and what is the new area of businesses that you have focused and that contributes how much percentage of our revenue today?
Actually, we have stopped on providing that kind of a share, going forward. We said that in the last quarter itself that we're not going to be providing that number because we have now expanded and broadened the vectors of growth that we're looking at in an account. And therefore, for us, what matters is what's the total contribution that we're getting from financial services itself as an industry vertical itself, which is in line with how everybody in our peer group also reports.
Great. Can I continue with one more?
Yeah.
So in the morning, Mr. Chairman guided for 1% margin improvement from pricing. Now, if I understand, this is a business where getting pricing increase and through that getting 1% margin improvement, especially when you are shifting more towards offshore, and you are talking that as a margin lever also, looks to me little disconnected between these two. So if you can help us to understand that, how pricing will help in which part of the business and how offshore will help in which part of the business? Thank you.
No, it's a great question. I think the way to think about pricing is on 2 or 3 counts, right? Number one is accounts where we might be running low margins from a profitability standpoint, or these might be tail accounts, etc., where our margins are not where they need to be, and the rate structure that we may not be conducive to what is required, right? In situations like that, there is an opportunity to go out there and renegotiate rates. So I think that's one bucket which will contribute to potentially a higher higher margins itself, if you will. The second part of it is where you're able to change the commercial model of what you're negotiating itself, right? So there are opportunities in some accounts where you can actually go out there and change what might be a headcount-based model to potentially a transaction or an outcome-based model and make it both revenue and margin accretive both. And third is in new deals that you might take on. You might end up having the opportunity uh, to construct the commercials in such a way that you can get the benefit of price realization as well. The fourth thing that is also possible is, uh, you know, sometimes after you win a deal and you're executing itself, which Sanjeev was referencing in the form of change requests. Lots of times what happens is solution assumptions might change from what you might have started off with. And there is an opportunity at the point when that solution assumption changes to go out there and renegotiate a different price point at that point in time as well. Oftentimes, service providers don't do a very good job of that. And that represents an opportunity as well. So combination of all, it's not one or the other, it's a combination of all of these levers that will provide an opportunity for a margin upliftment on the pricing side itself.
Questions?
Yeah, hi Ritesh, this is Vibhor here from Nuvama. The elephant in the room for us and probably the industry is, at this point of time, is the adoption of Gen AI. I think we've seen this mentioned by some of your competitors that the first and probably the most impact that the sub-vertical that is going to get there in terms of Gen AI is the BPO industry. We've seen our peers in US like EXL and WNS. They're also the investors and the management have expressed concerns about how the industry could be impacted by this. So what's your take on that? And more importantly, what is the, let's say, the trajectory that you see for that? I mean, is it going to be deflationary in the beginning and then probably more opportunity coming to our side? How do you see headcount reduction or maybe the increase thereafter? How does it play out for a company like us, which is predominantly at the forefront of this technology?
Thank you, Vibhor. Thanks for the question, as always. Great question. And look, I think Gen AI is going to probably end up being a double-edged sword for the industry, right? And I think you're going to see divergent commentary playing out from different players. I think at the size and scale at which we are neither too small that we don't get a seat at the table, and we are not too large that the sins of bureaucracy or the pangs of scale come back to bite us as well, right? But that being said, let me talk a little bit about what I see as the opportunity itself, right? So today, if I give the state of the landscape and what we are seeing in the market, we're at the top end of the hype cycle with Gen AI. When ChatGPT was launched by OpenAI, I think every board started, it was almost like an exam paper question that they had to ask their management teams, what are you doing on AI, right? So AI became an integral part of the board agenda, and everybody was starting to say, we're doing a bunch of POCs and pilots and so on and so forth. So the number of POCs and pilots from a proliferation standpoint was very high. Very few of them have actually gone into production deployment for a variety of reasons. Training cost is still very high. Compute capacity is not readily available, which is the reason why NVIDIA is doing phenomenally well as a stock even now, right? And there are still question marks from a hallucination standpoint from a model standpoint. You can't have, a question being responded, even one question being responded wrongly by a model, because that can impact the reputation of the brand itself, right? And so there's a reputation risk associated. So clients have been reluctant to adopt and put stuff in production in a heartbeat. But the bigger issue, right, which a lot of organizations are facing and a lot of our clients face, is the data to AI problem. Most enterprises don't have the data ready for AI. So the data quality that they have in their organization is suspect. And therefore, there's a lot more work that organizations today are doing in terms of getting their data ready for AI rather than actually, and of course, they're doing the bunch of POCs and pilots in a controlled environment so that they can see what success can look like. But I think that's where we are seeing the landscape itself. Now, look, what I will draw parallel to Vibhor is, 7 years back when RPA came into about, everybody said that's the doomsday for the BPO industry, and nothing's going to, everything's going to go downwards year on, guess what? Every BPO company built their own RPA centers of excellence, and that became a revenue stream. Actually, right now, what we are seeing in the market is we are seeing two or three plays, right? So number one, AI and generative AI is creating new revenue streams that didn't exist in the past. We are working today with a lot of consumer tech brands around the training models that need to be done from a critical reasoning standpoint, from a domain perspective, etc., which is either model creation, data collection, data validation, uh, model reasoning, all of these areas which didn't even exist as service lines even 12 to 18 months back. And those are now becoming quick revenue streams that are there, and we think those will continue to remain. Number one. Number two, we're also seeing an opportunity because of our size and scale to play on offense and to use AI and ML to actually have a very different construct in the market, which can be both revenue accretive and margin accretive. So, and we think that potentially is an opportunity for us to take share from some of the larger players who may be afraid to cannibalize their own business, or the smaller, undifferentiated players who don't have anything to stand for as well. So we think that creates an opportunity as well. What I do agree with you is going forward, the traditional way the sector has operated, whether it's IT or BPO or otherwise, where revenue and headcount have had a direct correlation, and there's been a linearity itself. I think some of those linearity elements will not necessarily play out in the same manner, and I don't think that's the way one should look at the industry itself to say if you've added X number of people, does it mean you're going to add revenue in the same proportion or otherwise? Because it may not necessarily correlate in that manner.
Got it. Got it. Thanks a lot for taking my question.
Hi, this is Ashish from InvestSavvy. One quick question. If you are looking to get more share of wallet from your top 50 customers, and at the same time you're discussing about repricing, as an opportunity. Now, normally repricing as an opportunity comes up when you have more, as a vendor, you have more power. Now, if you're trying to get more business, and then we start talking about repricing, which sometimes people take for granted in a lot of these places, that minor changes and all will be done. Do you see a conflict between the two objectives?
Actually, I don't, because let me tell you why, right? So I think repricing is not necessarily just a rate increase, right, in the true sense of the term. A rate increase is when you're running a true headcount-based model and you're saying, let me price at a widget level, right? If you're changing the commercial construct and you're underwriting an outcome, and or you're guaranteeing a fixed price to a customer, it can be both revenue accretive and margin accretive. So you can end up being in a scenario where both of these outcomes can be achieved by changing the way the commercial model itself can be there for a particular contract itself. Now, in some accounts where you see the headcount, the opportunity for growth, the headroom for growth exists, you may choose not to do something there from a commercial model standpoint in terms of pricing or something like that, because you see the significant wallet share expansion opportunity itself. But in certain other accounts where you might be performing really well, there has not been any commercial conversation for the last 3, 4, 5 years, and you see an opportunity to do something different, those are probably the low-hanging fruit where there is still an opportunity to increase margins, right? So I don't think these objectives are at conflict at all. I think you'll have to view this on a case-by-case basis. But this is the broad playbook of where and how you'll execute against this.
So you mean repricing more in terms of changing the commercial construct possibly, rather than actually asking for incremental revenue just because some work has changed?
Yes, but there could also be situations where you, let's say, are running low margin accounts, and they might be tail accounts, and you have a choice. You might go to the customer and say, listen, it's a tail account. It's you're really hitting the ball out of the park from a service delivery standpoint, and your price points are not where they need to be. In a situation like that, you can afford to, you have pricing leverage on your end to go out there and negotiate for a higher price because you're delivering very well from a services standpoint, right? So in a situation like that, you can go out there and ask for that. And we have done that, by the way. In the last 3 months, we had a situation where we were losing money on a particular account, and my message to the account team was, if you don't do it, I will. So you decide how you want to do this, right? And in a situation like that, you can very well go ahead and do that. So I'm giving you an extreme situation, but it's not that those situations don't exist in a portfolio, right?
Take one more question if we have. Anybody? I think we are pretty much done with the questions. Would you like to say something? Yeah? No? Anybody? Any questions? I think we are done, Mr. Ritesh. The questions are done. And can we wrap this session?
Any closing comment, Ritesh, you want to make?
I think the only closing comments I would say is that we are, the first source that you may have known of and may have interacted with is a very different beast today. We are taking full advantage of the macro and technology shifts that are presenting opportunities to us. Those opportunities are creating the playbook to operate on offense, which is firmly what we are doing. We think this environment is going to create a divergent growth environment. We don't think every player in this environment is going to grow uniformly. And with what we have done with our deep domain, our desire and our choices to operate in a defined set of swim lanes, where we are an inch wide and a mile deep, lead with tech first, use that to proactively grow our share, and also take share from some of our larger incumbents, I think creates an opportunity for Firstsource to grow at a much faster pace compared to the rest of the industry while continuing to improve margins. So I think watch this space, but I think that's the playbook we've been executing over the last 3-4 quarters as well. And that's essentially what you'll expect to see us going forward as well. One Firstsource will continue to be our North Star for how we operate. So hold us accountable on that. And thank you for the interest in the session.
All right. Thank you once again, Mr. Ritesh Idnani, for being here with us all the way from US virtually. And thank you, Mr. Pankaj Kapoor. Thank you very much, Mr. Dinesh Jain. Thank you, everybody.